This simplified chart shows a classic setup. You spot a clear upward trend, place a buy order, and set a standard 20-pip stop-loss. Then the price violently drops. It wicks you out by a single pip, closes the trade, and immediately rallies where you predicted. Your first instinct is probably to blame the broker, assume the market is actively hunting your stops, or doubt your own strategy entirely. But your directional analysis was perfectly accurate. The problem was that a rigid 20-pip rule couldn't survive the routine, everyday noise of the market. Forcing static, round numbers onto a constantly shifting environment guarantees failure. To survive, you have to stop guessing and start measuring the market's actual heartbeat. This animated candlestick chart introduces the average true range, or ATR. It calculates the precise distance from the highest high to the lowest low over a set period, usually the last 14 candles. It doesn't tell you if the price is trending up or down, and it ignores momentum completely. It is purely a ruler for statistical volatility. By mapping out that average distance, the ATR establishes a noise zone, a measurable band where normal, random price fluctuation is mathematically expected to occur on any given day. If we replay our original failed trade, but this time apply a 2 times ATR multiplier, we place our stop-loss firmly outside that expected breathing room. Now, when the exact same violent drop hits, it gets absorbed entirely by the noise zone. Your trade stays alive, and you capture the rally. Using a dynamic buffer ensures that a stop-out only happens when your foundational trade idea is mathematically wrong, rather than when the market simply takes a breath. This dynamic measurement also solves target fatigue. That happens when you hold out for a 50-pip gain in a market that is mathematically unlikely to move another 10 pips today, causing your winning trade to stall and eventually reverse. This split-screen comparison shows the solution. On the left, a static target remains entirely out of reach. On the right, by setting take profits to exact ATR multiples, like 4 times the ATR for a 1-to-2 reward ratio, the target lowers itself to match the shrinking volatility. When volatility increases and strong trends develop, you can apply an advanced ATR-based trailing tactic known as the chandelier exit. This diagram illustrates how it works. The stop-loss distance is suspended strictly from the highest peak of the current trend. As the price makes new highs, the stop-loss steps up with it, like a hanging chandelier. Because the distance expands and contracts based on ATR, it easily ignores the mid-trend pullbacks and corrections that consistently trigger a standard fixed trailing stop. By syncing both profit targets and exit triggers to current volatility, you move past arbitrary levels and start basing your exits on what the market is statistically capable of delivering. However, there is a hidden mathematical danger to this system. If your stop-loss distance is constantly changing in pips, maintaining a constant lot size will completely destroy your risk management. Look at these 2 identical trade setups. Trade A hits a calm 20-pip ATR stop, resulting in a $200 loss. Trade B hits a volatile 60-pip stop, which triggers a massive $600 loss. To fix this discrepancy, you must implement volatility-adjusted sizing on every single trade. This image displays the required formula. Calculate your exact lot size by dividing your total fixed dollar risk by your ATR stop-loss distance in pips. During high volatility, your wider stops require purchasing smaller lot sizes. During calm markets, tighter stops allow you to purchase larger lot sizes. Through this exact inverse relationship, the total capital you risk remains locked at exactly 1% on every single trade, regardless of market chaos. Incorporating ATR ensures your risk management is always calibrated to the current environment. To begin applying these volatility metrics, download the FXNX ATR cheat sheet, utilize our dynamic position size calculator, and open an NX1 account for